Happy Friday, Eric Bible with the Bible team at Neil Home Loans. Nothing beats a summer Friday, but maybe interest rates being back in the twos and abundance of homes. Sure think that would be, but we all know that not to be the case. So you know what? We're going to run with the summer Friday instead, but definitely some Friday vibes to say the least, as mortgage interest rates are poised to improve on some of the news that came out today. And I want to dive in on the all important PCE, which is driving the market movement today. And are we seeing more signs of a slowing economy and what that ultimately means for us, our borrowers, our customers, and the overall market as a whole? So let's get into it. As of this morning, the 30-year fixed is sitting right at 7.05%. Yes, that's up from last week, 7.02. But given the information received this morning with personal consumption expenditures, it does appear that we're going to see some rate relief. So still too early to show. Rate sheets have yet to publish, but given how the market is open in response to PCE, it does appear that we're going to see some more favorable rates as the day progresses. So definitely come back next week. We'll have more info on that. So let's jump into PCE, personal consumption expenditures. As we know, this is the Fed's favorite measure of inflation. When we continue to hear that 2% target, this is really what they're referencing. This in core as personal consumption expenditures is all dollars that are spent for household goods and services by the consumer. So these reports are for the month prior. So this reading was for May. And really, there was no whammies. It came in right at expectations. Market was anticipating a 0.1% increase on a month over month basis, which was down from April's 0.2. But most importantly, the year over year reading in April was 2.8. Market was expecting a 0.2% decline for the month of May, bringing it down to 2.6. And guess what? We got just that. So the big question becomes, given the fact that now we've seen a consistent trend with a decline on inflation, uh, does this give credence to the Fed to start cutting rates? Now, obviously, I don't know the answer. The only entity that knows that answer is the Fed. But the argument is getting more credence with the improvements that we continue to see from CPI, unemployment, now PCE. Time will definitely tell. But today we're going to bask in it as it's definitely improving market. So we do expect to see improvements in rate sheets throughout the day and into next week. So we'll run with it. Then the big question becomes, well, additional signs of a slowing economy. We had, CPI earlier this week, or earlier this month, I should say. Unemployment ticked up earlier this month. We get another unemployment reading with the Bureau of Labor and Statistics next Friday, right after the 4th of July. And it will be interesting to watch. And the question just continues to come forward is, well, if the economy is slowing, isn't that bad for housing? And if we look back to history, the answer is no, it's the opposite. An economic slowing is bode well in both housing and mortgage. And we have to look at it from the optics of the Fed's primary role is price stability and maximum employment. When we start to see an economic slowdown, really the Fed's job is to stimulate the economy. How do they do that? Well, they have to lower the cost to borrow. That means they have to cut rates. They have to provide incentives for the consumer to actively engage in spending behavior. So here where, yes, I don't like a recession, but given what we've experienced over the last 2 years, interest rates doing the things that they've done, buyers forced to the sidelines due to affordability constraints, a slowdown might not necessarily be a bad thing. So here with all that is percolating within the system, with inflation moderating, unemployment creeping up, this could be really the golden opportunity. And I challenge you all to use this information as a touch point to your consumers. The last thing you want is them to hear the news from a different source, as opposed to you actively engaging with them and letting them know what you're seeing, and in turn how that can impact their future buying decisions. So, as always, if you're running into challenges with communicating this message, scripting around it, we have ample resource to assist. As always, make it a fantastic Friday and an even greater weekend. Thank you again.